Hedge Fund Market Wizards, by Jack D. Schwager. Introduction. Imagine it's the 1950s. A young math professor, brilliant but unknown, takes a trip to Las Vegas with his wife. He knows better than to gamble. He understands the odds are always stacked in the house's favor. But he hears about a new strategy for the game of blackjack, one that lets you play almost even with the house. He thinks, why not? It could be fun. He sits down with 10 silver dollars, plays for a while, and loses 8 of them. Most people would walk away, shaking their head at the allure of gambling. But this man, Edward Thorpe, wasn't most people. He saw something others missed. He realized that while the odds were fixed for a full deck, they changed with every card that was dealt. What if you could keep track? What if you could know when the odds shifted, even slightly, in your favor? This simple question led him on an obsessive journey. He spent thousands of hours running calculations, first on a slow desk calculator, and then on one of the world's first massive IBM computers at MIT. He discovered something that casinos insisted was impossible: a mathematical system to beat the game of blackjack. He wrote a book about it, Beat the Dealer, and it sent a shockwave through the gambling world. Casinos changed their rules because of him. But he didn't stop there. He and a colleague, the famous Claude Shannon, built the world's first wearable computer, a tiny device hidden in a shoe, to predict the outcome of a roulette wheel. They proved they could gain a staggering 44% edge on the house. But even beating casinos wasn't enough. Thorpe realized there was a much bigger game, the biggest casino in the world, Wall Street. He turned his brilliant mind to the markets, and what he accomplished there would not only make him a legend but would also shatter the academic theory that no one can consistently beat the market. For decades, an elite group of traders, thinkers, and innovators like Ed Thorpe have been quietly achieving the impossible. They are the market wizards. And for years, one man has dedicated himself to finding them, sitting with them, and convincing them to share their secrets. That man is Jack D. Schwager. His book, Hedge Fund Market Wizards, isn't just a collection of interviews. It's a masterclass in the art and science of winning. It pulls back the curtain on a world that is notoriously secretive, a world of unimaginable wealth and crushing pressure. Schwager's work has inspired a generation of the world's best investors, and it's sold millions of copies for one simple reason: the lessons are timeless. In our journey today, we're not just going to talk about stocks and bonds. We're going to decode the mindset of these winners. We'll discover the rules they live by, the catastrophic mistakes that nearly destroyed them, and the profound principles that you can apply not just to investing, but to any high-stakes game in life where you need an edge. By the end of our conversation, you will understand that the secret to winning isn't about predicting the future, it's about mastering yourself. Book summary. Let's begin by dispelling a myth that trips up so many people when they first approach the world of investing. It's the belief that there's a secret formula out there, a holy grail that, if found, will unlock the markets and guarantee success. Many people read books like this one hoping to find that one magic trick. But as Jack Schwager himself points out, anyone looking for an easy formula is looking in the wrong place. The very first lesson the wizards teach us is that there is no holy grail. There is no single right way to trade. In fact, if you look at the traders in this book, their methods are wildly different, sometimes even polar opposites. You have someone like Colm O'Shea, a global macro trader. He thinks like a historian and a politician, looking at the grand sweep of global economics to make big bets on currencies, interest rates, and entire countries. His journey began not in a finance class, but in a dusty open market in Rome, where the only English book he could find was a tattered copy of Reminiscences of a Stock Operator. That book, a story about the psychology of markets, brought everything in his life together. He saw that trading wasn't just about numbers on a screen, it was about understanding the big picture, the fundamental tides of the world economy. And then you have someone like Jaffrey Woodruff, who couldn't be more different. Woodruff is a quantitative trader, a quant. He works with pure data. When he was young, he wasn't reading about politics. He was obsessively rolling dice to see probability in action and programming one of the first home computers to roll them even faster. When he decided to tackle the markets, he did something that went against all conventional wisdom. The two main approaches for computerized trading were trend following, betting that a market moving up will keep going up, and mean reversion, betting that it will reverse. Woodruff rejected both. He said, "I'm not going to be a trend follower. I was never going to be a trend follower." That was clear. Why? Because his contrarian personality couldn't stand being part of the herd. He wanted to do something completely different. So he locked himself in a university computer lab, and fueled by Pepsi for nearly 40 hours straight, he began searching for a third way. He developed a system that looks for complex patterns in price data, patterns that are neither trend following nor counter-trend. He built a method that was entirely his own, one that fit his unique, analytical personality. So you have the storyteller, O'Shea, and the mathematician, Woodruff. You have value investors like Joel Greenblatt, who spend their time searching for good businesses that are on sale, like a shopper looking for a bargain. And you have tape readers like Jimmy Baladimas, who uses almost no fundamentals or long-term charts, but has an intuitive feel for the market's rhythm second by second. Each of them found a path that worked for them. And this is perhaps the most fundamental lesson of all. As Colm O'Shea puts it, "If I try to teach you what I do, you will fail because you are not me." What he learned was not to become me. He became something else. He became him. You have to find a method that fits your personality. A strategy that makes one person a fortune can bankrupt another if it doesn't align with how their mind works, what they believe, and how they handle pressure. The journey isn't about finding the perfect system. It's about finding the system that is perfect for you. And once you start on that journey, you quickly learn the most paradoxical truth about winning in the markets. The very best traders are not obsessed with making money. They are obsessed with not losing it. This brings us to our second great theme, the art of losing. The true secret of the wizards isn't their genius at picking winners, it's their genius at managing risk. Let me tell you a story about a trader named Larry Benedict. His early career was, to put it mildly, a complete disaster. He got fired from his first job as a clerk on the trading floor. He then got a job as a trader and promptly blew through his entire account. The firm gave him a second chance with more money, and he lost most of that too. Then a friend gave him a stake to trade, and he lost so much, so quickly, that his friend pulled the plug before he even hit his loss limit. By all rational measures, Larry Benedict should have quit. He had no evidence of any trading skill. He was a consistent failure. But he never gave up. And eventually, he figured it out. He went on to have 20 consecutive profitable years, becoming one of the most consistent traders in the business. What changed? He learned the single most important lesson: risk management dominates everything. For Benedict, it's not about how much money he can make. It's about how little he can lose. His rules are astonishingly strict. If his entire fund loses just 2.5% in any given month, he does something that would terrify most managers. He liquidates the entire portfolio. He starts the next day with a clean slate, trading at a much smaller size until he starts making money again. Because of this discipline, in over a decade of trading, his worst single month was a loss of only 3.5%. He knows that if he can manage the risk, the profits will eventually take care of themselves. This obsession with controlling the downside is a theme that echoes through almost every wizard's story. Michael Platt, the co-founder of Blue Crest, one of the world's largest hedge funds, has a similar system, but on an even grander scale. When he hires a trader, he gives them a pile of money to manage and a simple rule: if you lose 3% of that capital at any point during the year, you are stopped out. Your book is liquidated, and your year is over. It's not a suggestion, it's an unbreakable law. This structure creates what Platt calls a right-skewed return profile. The maximum loss is strictly limited, but the upside is open-ended. But simply having a stop-loss isn't enough. Many traders use them, and still fail. Colm O'Shea gives us a subtle but crucial insight into why. He says most people make the mistake of setting their stops based on their pain threshold. They decide they can't bear to lose more than, say, $1,000 on a trade, so they place their stop there. The problem is, the market doesn't care about your pain. A meaningless wiggle in the price can hit your stop, take you out of a good trade, and then the market goes right where you thought it would. Worse, because you still believe in the idea, you get back in, only to get stopped out again, dying a death of 1,000 cuts. O'Shea teaches a different way. He says the process should be reversed. First, you must ask, at what price would my original idea be proven wrong? Maybe the stock breaking below a major support level would invalidate your thesis. That is where your stop should be. Only after you determine that price do you decide on your position size. If the loss from your entry point to your I'm wrong point is too large for you to stomach, you don't move the stop closer. You reduce your position size until the potential loss is comfortable. With this method, getting stopped out isn't a moment of pain, it's a moment of clarity. The market is simply telling you that your hypothesis was incorrect. There's no emotional attachment, no desire to jump right back in. You were wrong, you accept it, and you move on. This visceral understanding of risk often comes from a painful, formative experience. Ray Dalio, the founder of Bridgewater, the largest hedge fund in the world, calls it the electric shock. Early in his career, he was long a commodity called pork bellies. The market turned against him and went limit down day after day, meaning the price dropped so fast that trading was halted. He was losing a huge amount of money, and he had no way to get out. He didn't know when the losses would end. That feeling of absolute helplessness and fear taught him a lesson he never forgot: the paramount importance of risk control. He says, "I never wanted to experience that pain again." That pain is a gift. And this leads us to our third great theme: the incredible power of mistakes. While most people see mistakes as something to be ashamed of, something to hide, the wizards see them as the most valuable asset they have. The trader who embodies this philosophy more than any other is Ray Dalio. He's been called the man who loves mistakes. At his firm, Bridgewater, he has built a culture around a concept he calls radical transparency. Virtually all meetings are recorded and made available for employees to review. People are encouraged to challenge each other, even their superiors, openly and honestly. The goal is to get at the truth, and Dalio believes the only way to do that is to put every idea and every decision under the microscope, especially the ones that fail. He says, "I learned that there is an incredible beauty to mistakes because embedded in each mistake is a puzzle and a gem that I could get if I solved it. A mistake isn't a failure, it's a signal that something in your process, or your way of thinking, is wrong. If you can have the humility to analyze that mistake, find its root cause, and create a new rule or principle to prevent it from happening again, you don't just recover from the mistake, you evolve. You get stronger." This isn't just a business philosophy for Dalio, it's a life philosophy. And it's a mindset shared by all the great traders. Larry Benedict's years of failure weren't wasted time, they were his education. He says, "The lessons I learned from those early failures helped me become successful. They taught him what not to do, which is often more important than knowing what to do." Steve Clark was put in charge of a trading book for the first time on October 19, 1987, the day of the biggest stock market crash in modern history. He came in that morning with a portfolio that was 100% long stocks his boss had bought the week before. He was thrown into the fire on day one. That searing experience taught him a lesson that stayed with him his entire career: anything can happen. The key is not to avoid mistakes, because you can't. The key is to learn from them. A powerful piece of advice comes from Steve Clark, who tells the traders who work for him a simple mantra: do more of what works and less of what doesn't. This sounds obvious, but it requires a level of self-awareness that few people possess. It means you have to be a ruthless detective of your own performance. You have to analyze your trades and ask, where are my profits really coming from? What setups, what market conditions, what mindsets lead to my best trades, and where do I consistently lose money? Often, traders will have one strategy that works beautifully, but they'll give back all their profits by dabbling in other things out of boredom or ego. The discipline to identify your strengths and stick to them, while eliminating your weaknesses, is a game changer. This process of constant self-correction and improvement requires another essential quality: flexibility. The market you mastered yesterday might not be the market that exists tomorrow. This is our fourth theme: the necessity of adaptation. A strategy that works for years can suddenly stop working. Why? Because, as Colm O'Shea says, the world changed. The markets are not a static entity. They are a living, breathing ecosystem that is constantly evolving. The rise of hedge funds themselves has changed the game. New technologies, new regulations, and new global dynamics constantly shift the landscape. A trader who clings to a rigid set of rules because they used to work is destined to fail. The great traders are masters of adaptation. They have core principles, yes, but their tactics are fluid. Consider Colm O'Shea's performance in 2009. In April of that year, coming out of the great financial crisis, he was deeply pessimistic about the global economy. His analysis told him the world was in terrible shape. But the markets started to go up. Stock markets in Asia started to rally. Commodity prices began to firm up. The price action was directly contradicting his worldview. A lesser trader would have stubbornly held on to his bearish positions, insisting the market is wrong. But O'Shea had the flexibility to say, the market is telling me that I am wrong. He didn't fight the evidence. He sat back and formulated a new hypothesis that could explain what was happening. Perhaps the world was on the verge of an Asia-led economic recovery. He completely reversed his stance, went from bearish to bullish, and turned what could have been a disastrous year into a profitable one. That is flexibility in action. Sometimes, the adaptation has to be even more fundamental. Jimmy Balodimas made his name as an aggressive short seller, a trader who faded rallies. But over the years, he noticed a change. The rise of hedge funds and high-frequency trading had made trends more persistent. Rallies that would have fizzled out in the past were now lasting longer. His old method of stepping in front of every move was becoming more dangerous. He had to adapt. He didn't abandon his style, but he became more selective, less aggressive, and more willing to admit when a trend had real momentum. Edward Thorpe provides another classic example. His first statistical arbitrage system worked brilliantly. But as more competitors entered the space, he saw the returns start to decline. So he innovated, adding a new layer to the strategy to make it sector neutral, which improved performance. When that, too, started to lose its edge, he adapted again, developing a more sophisticated factor-neutral model. He was in a constant research war, always staying one step ahead. A good trader builds a boat that can sail in today's weather. A great trader builds a boat that can be refitted for the storms and calms of tomorrow. This ability to adapt often goes hand in hand with a certain way of looking at the world, a tendency to question the prevailing wisdom. This brings us to our fifth theme, the power of the contrarian mindset. Many of the best traders have a natural inclination to go against the crowd. They are suspicious of consensus. When everyone agrees on something, their internal alarm bells start to ring. Jimmy Baladimas lives by a simple philosophy: smart guys always sell when the market is going up. He has made a career of what he calls stepping in front of freight trains, selling into powerful rallies and buying into terrifying declines. His logic is that markets are driven by human emotion, and crowds are notoriously emotional. They get overly euphoric at the top and overly panicked at the bottom. The greatest opportunities, he believes, lie in betting against that irrationality. In early 2011, the price of silver went on a parabolic run. News about inflation was everywhere. Everyone was talking about precious metals. Baladimas saw this and thought, they are really pushing the story very hard. It felt like everybody was buying silver. Those are the opportunities I look for. While the crowd was piling in, he was quietly building a short position. When the bubble inevitably popped, he made a fortune. This isn't just about fading short-term moves. It can be about making huge, long-term macro calls that go against the entire world. Martin Taylor's story about Russia in the late 1990s is a perfect example. In 1997, as a crisis was unfolding in Asia, investors were desperately looking for a new place to put their money. Wall Street brokers began touting Russia as a post-communist miracle. Money poured into the Russian stock market, which more than tripled in value. The consensus was overwhelmingly bullish. But Taylor, who managed an Eastern European fund, looked at the fundamentals and saw a very different picture. He saw a country living far beyond its means, with massive capital flight and a ballooning deficit. He realized it was a house of cards. At the time, Russia made up 40% of the benchmark index for his fund. Making a bet against it was a huge career risk. But his conviction was absolute. He sold every single Russian stock he owned, taking his fund's allocation to Russia to zero. His clients and colleagues thought he was crazy. But he stood his ground. He saw a moment coming when, as he put it, the market realizes that the emperor has no clothes. And in August 1998, that moment arrived. Russia defaulted on its debt, the currency collapsed, and the stock market was wiped out. Taylor's contrarian call saved his fund from disaster. Being a contrarian doesn't mean always doing the opposite of the crowd. It means you do your own thinking. You develop your own thesis, and you have the courage to stick with it, even if it means standing alone. But having a great idea, whether it's contrarian or not, is only half the battle. This leads to our sixth, and final, major theme. The edge is often in the implementation, not just the idea. How you structure, execute, and manage a trade can be even more important than the initial idea itself. Let's go back to Colm O'Shea. After the dot-com bubble burst in March of 2000, his big idea was simple: bearish on stocks. The obvious trade would have been to short the NASDAQ index. But O'Shea knew that bear markets are treacherous. They have vicious, face-ripping rallies that can destroy short sellers. In the summer of 2000, the NASDAQ, in the middle of its crash, suddenly rallied by 40%. Had O'Shea shorted the index, he almost certainly would have been stopped out for a huge loss. But he didn't short the index. He looked for a smarter way to express his bearish view. He reasoned that a stock market crash would lead to an economic slowdown, and a slowdown would force the Federal Reserve to lower interest rates. Lower interest rates mean higher bond prices. So instead of shorting stocks, he bought bonds. He was trading the consequence of his idea, not the idea itself. While the NASDAQ was swinging around wildly, the bond market enjoyed a relatively smooth, calm uptrend. He had the right idea, but more importantly, he found the best possible implementation of that idea. This search for the best expression of a trade is a hallmark of the Wizards. Jamie Mai of Cornwall Capital is a master of this. His entire philosophy is built around finding asymmetry, trades where the potential upside is many, many times greater than the potential downside. His most famous trade was his bet against the subprime mortgage market before the 2008 crisis. His idea was that the housing bubble was unsustainable and the mortgage-backed securities built on it were junk. But instead of trying to short the housing market directly, which was difficult and expensive, he found a much more asymmetric way to play it. He bought very cheap, out-of-the-money options, specifically, credit default swaps on the lowest-rated tranches of mortgage bonds. Because these instruments were considered so safe by the official rating agencies, the insurance on them was incredibly cheap. He was risking pennies to potentially make dollars. His risk was strictly defined and very small. But if he was right, and the housing market collapsed, his potential profit was astronomical. When the crisis hit, he tells the story of positions that were marked at $50,000 on a Friday and which he sold for $4.5 million on the following Monday. That is the power of asymmetry. He had a brilliant idea, but his true genius was in finding the most leveraged, lowest-risk way to implement it. This concept of structuring trades to have a built-in edge goes all the way back to our first wizard, Edward Thorp. When he discovered that stock warrants were often mispriced, he didn't just buy the ones he thought were cheap. That would have exposed him to the risk of the overall market going down. Instead, he created a market-neutral position. He would buy the underpriced warrant and simultaneously sell short a corresponding amount of the underlying stock. The result was a position that had very little exposure to the direction of the market, but had a statistical edge that he could profit from as the mispricing corrected over time. He isolated the inefficiency. So, what do all these stories tell us? They tell us that greatness in trading is not a single skill. It is a combination of many. It's the analytical rigor to develop a thesis, the contrarian courage to stand by it, the flexibility to abandon it when the evidence changes, the humility to learn from mistakes, and the obsessive discipline to manage risk above all else. These are not just trading principles. They are principles for navigating a world of uncertainty, for making smart decisions when the stakes are high, and for continuously growing and improving, no matter what field you choose. The Wizards have mastered the market, but their real victory is the mastery of themselves. Commentary. As we step back and look at the lives and methods of these incredible traders, what is the single biggest lesson we can take away? I think it's this: the secret to winning in the markets isn't a financial secret at all. It's a human one. The market is often described as a complex machine, a system of numbers and charts and economic data. But that's not what it is. At its core, the market is a reflection of human nature. It's a global arena where millions of people's hopes, fears, and beliefs collide every second. And because it's driven by people, it's subject to all the classic human follies: greed, panic, herd behavior, and wishful thinking. The Wizards are not wizards because they have a crystal ball that can predict the future. They are wizards because they have achieved a deep, practical understanding of human psychology, starting with their own. They have learned how to manage their own emotions, how to remain rational when everyone else is going crazy, and how to recognize and exploit the predictable mistakes that others make. This is why their lessons are so valuable, even if you never plan to buy a single stock in your life. The skills they've mastered are life skills. Think about it. We all have to make decisions under uncertainty. We all have to manage our emotional capital. We all face setbacks and have to learn from our mistakes. The principles these traders live by can be applied to almost any challenge you'll ever face. So, how can you start applying these ideas today, right now, in your own life? Let me suggest 3 simple practices. First, start a mistake journal. This is the Ray Dalio method. The next time you make a mistake, it could be on a test at school, in a conversation with a friend, or while playing a sport, don't just brush it off. Take a few minutes to write down exactly what happened, why you think it happened, and what principle you can learn from it to avoid repeating it. This simple act of reflection turns every failure into a stepping stone for future success. It builds self-awareness, which is the foundation of all mastery. Second, practice thinking in probabilities. This is the Edward Thorpe and Jamie Mai method. Before you make any significant decision, get in the habit of asking 3 questions. What is the best possible outcome, the upside? What is the worst possible outcome, the downside? And what is the most likely outcome? By consciously thinking about the range of possibilities instead of just hoping for the best, you train your mind to be more realistic, to see risks more clearly, and to make smarter choices. You start to see life not as a series of certainties, but as a game of odds that you can learn to tilt in your favor. And third, actively question the consensus. This is the contrarian mindset. When all your friends love the same movie, listen to the same music, or believe the same thing about a particular issue, take a moment to genuinely explore the opposite argument. Try to build the strongest possible case for the other side. This isn't about being disagreeable, it's about training your mind to think independently. It protects you from the dangers of herd mentality and opens you up to opportunities that the crowd always misses. The market wizards are a rare breed, but the qualities that make them successful, discipline, humility, resilience, and an endless curiosity, are not magical gifts. They are skills. They are muscles that can be trained. The market was their gym, but the principles they practiced are universal. They teach us that the ultimate investment is not in stocks or bonds, but in the relentless, lifelong project of understanding and improving ourselves. That was a summary of Hedge Fund Market Wizards by Jack Schwager. We've certainly covered a lot of ground today, touching on the core principles that have guided some of the most successful investors in history. But I'll be honest with you, a summary can only ever be a map. The real treasure is found when you make the journey yourself. The true magic happens in the quiet moments of reading, when a particular story or a simple phrase from one of these wizards connects with you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time and attention. If anything we've talked about today has sparked your curiosity or resonated with a part of you that longs to understand the game of life a little better, then I encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change the way you see yourself and the world of possibilities around you. The link to the book is in the description below. Also, if you found this journey valuable, please take a moment to click that like button and subscribe to the channel. It tells us we're on the right track, and it ensures you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Thank you for joining me. Let's keep growing together.